December 22, 1994, Mexico City. The Mexican government has just run out of dollars. Not low on dollars, not short on dollars out. The foreign exchange reserves of the 11th largest economy in the world, a country that signed a free trade agreement with the United States and Canada 11 months ago, a country that the Wall Street Journal called the star pupil of emerging market reform just 18 months earlier, has approximately $6 billion in reserve against $29 billion in short-term debt that must be repaid within weeks. The peso loses 15% of its value in a single day, then another 15% the next day. By January 1995, it has lost half its value. Mexican interest rates spike to 80%. The economy contracts by 6% in a single year. 2 million Mexicans lose their jobs, and the financial panic spreads to Argentina, Brazil, Thailand, the Philippines, and Hungary within weeks, infecting countries that had done nothing wrong by any measurement their governments had been given, because the investors fleeing Mexico are fleeing all emerging markets simultaneously, and they cannot distinguish between them fast enough to matter. Middle-income countries' currency crisis becomes a global financial contagion in 72 hours. That had never happened before, and the specific instrument that transmits the Mexican crisis to global markets, a type of short-term government debt called TESOP, is an instrument that the Mexican government invented precisely to reassure foreign investors that their money was safe. The reassurance is what kills them. How does a guarantee of safety become the mechanism of collapse? And why does the architecture that produced Mexico's 1994 crisis, a fixed exchange rate supported by short-term dollar-indexed debt issued to foreign investors seeking yield, keep reappearing in sovereign debt crises from Russia in 1998 to Argentina in 2001 to Turkey in 2018 and beyond? This is the story of the Tequila crisis. By the end you will understand how a currency peg becomes a trap, see the specific instrument that converts a domestic liquidity problem into an international panic, and recognize the version of this structure that is operating in emerging markets right now. But to understand how this happened, you have to go back, way back. It is the late 1980s. Mexico City, and the city carries the exhaustion of a decade of crises like a man who has been carrying a heavy sack for so long that he has forgotten what it felt like to walk without it. The 1982 debt crisis, when Mexico became the first major economy to announce it could not service its foreign debt, had triggered a lost decade of austerity, inflation, and economic stagnation across Latin America. By the end of the 1980s, Mexican inflation has run at over 100% per year for 3 consecutive years. The peso is worth a fraction of what it was when most Mexicans alive can remember. Trust in the currency, in the banks, in the government's ability to manage the economy, has been ground down to almost nothing by a decade of failed fixes and broken promises. Into this exhaustion comes Carlos Salinas de Gortari, who takes office as president in December 1988 after an election whose results are disputed and whose computers, in a phrase that becomes a national joke, crashed at exactly the moment the opposition candidate appeared to be winning. Salinas is a Harvard-educated technocrat surrounded by other Harvard-educated technocrats, and he comes to office with a plan that is, in its broad outlines, exactly what the IMF, the World Bank, and the US Treasury have been prescribing for troubled developing economies for a decade. Privatize state enterprises, open the economy to foreign trade and investment, cut the fiscal deficit, control inflation by fixing the exchange rate. The plan works, at first, with an efficiency that produces exactly the kind of success story that Washington institutions need to show the rest of the developing world. The economic engine that Salinas assembles between 1989 and 1993 runs on 3 interconnected systems. The first is privatization. State enterprises, including the National Telephone Company, 18 commercial banks, and hundreds of smaller state businesses are sold to private investors, generating one-time revenues that help close the fiscal gap and creating a new class of Mexican billionaires almost overnight. Carlos Slim buys Telmex in 1994, $1.76 billion in a privatization process that, as the OECD later notes in a 2012 study of Mexican competition policy, creates a telephone monopoly that charges among the highest rates in the world for the next 2 decades. The second engine is NAFTA, the North American Free Trade Agreement negotiated between 1991 and 1993, and signed into force on January 1, 1994. NAFTA is a genuine political achievement, a treaty that opens the Mexican market to American and Canadian goods and opens the American and Canadian markets to Mexican exports. and it triggers an investment boom as foreign manufacturers build or expand factories in Mexico to access the combined market. The third engine is capital account liberalization, opening Mexico to foreign portfolio investment in its stock market, its government bonds, and its banking system. 2. Most analysts in Washington and New York in 1992 and 1993. This seems like exactly what a developing country is supposed to look like after successful reform. GDP growth is running at 3%. Inflation has fallen from over 100% in 1988 to under 10% by 1993. The stock market has increased tenfold. In dollar terms, between 1990 and 1993, foreign investment is flowing in at record rates. The peso is stable, but beneath the surface, a specific structural tension is tightening. Meet Pedro Aspe. He is Mexico's finance minister. From 1988 to 1994, an MIT-trained economist who designs and executes the stabilization program with a precision that earns him a reputation as one of the most technically accomplished finance ministers in the developing world. He believes in the program. He believes in the peg. The peso has been anchored to the dollar since 1988, initially at a fixed rate and then in a crawling band that allows slow, predictable depreciation, and Aspe believes the anchor is what makes everything else possible. Without currency stability, investors will not lend. Without lending, growth stops. Without growth, the political support for reform collapses. He is not wrong about any of this. The peg is doing exactly what he says it is doing. The problem is what else it is doing. Rudiger Dornbusch sees the problem from MIT and names it with specific numbers. He is one of the most respected international macroeconomists of his generation, and in a 1994 paper written with Alejandro Werner, a Mexican economist who will later become the IMF's Western Hemisphere director, he publishes a calculation showing that the peso is overvalued by approximately 20 to 30% against the dollar, that Mexico's current account deficit is running at 8% of GDP and growing, and that this combination of an overvalued currency and a large current account deficit has historically preceded currency crises in countries that rely on foreign capital inflows to finance the gap. The paper is published in the Brookings Papers on Economic Activity, a leading academic venue. ASP's office dismisses it. Salinas' advisors call the methodology flawed. The peso stays where it is. And then there is Jorge Castillo. He is a Mexico City bond trader in his early 30s who has made his career in the boom years of the early 1990s, trading Mexican government paper for a mid-sized brokerage and earning the kind of money that his father, a schoolteacher in Guadalajara, could not have imagined. He buys and sells tesobonos for client accounts, the dollar-indexed government securities that the Mexican Treasury has been issuing in increasing volumes since 1993. And by late 1994 he is uncomfortable with how many of them his clients hold. When the peso moves even slightly in the wrong direction, tesobono prices move sharply, and the volume of tesobonos outstanding has grown from under $1 billion at the start of 1993 to over $29 billion by late 1994. He starts quietly reducing his clients' exposure. In October 1994, he does not tell anyone he is doing it. What none of them know yet is that the two shocks that hit Mexico in 1994 are about to make every piece of this architecture collapse. Simultaneously, January 1, 1994, the day NAFTA takes effect, and nothing will ever be the same. Not because NAFTA fails, because something else happens. On the same morning that NAFTA enters into force, a guerrilla uprising begins in the southern state of Chiapas. The Zapatista National Liberation Army, a group that has been organizing in the Chiapas highlands for years, seizes several towns and issues a declaration denouncing NAFTA as a death sentence for indigenous communities. The Mexican army responds with force. The conflict is contained within weeks. But the political shock to foreign investors who had been told that Mexico had left its turbulent past behind is immediate. Capital flows slow. The current account deficit continues running at 8% of GDP. Reserves begin declining. Then, in March 1994, Luis Donaldo Colosio, the presidential candidate and almost certain next president of Mexico, is shot and killed at a campaign rally in Tijuana. Mexico has not had a political assassination of this magnitude in decades. Capital flows slow further. By June, reserves have fallen from over $26 billion to around $17 billion. The government is intervening in the currency market, selling dollars to defend the peso band. but it is not telling anyone how fast the reserves are falling because the reserve data is not published in real time. The weekly reserve figures are reported with a 3-week lag. Foreign investors buying Mexican assets in June 1994 do not know what the June reserve figures are. They will not know until July, when the lag resolves. By then, it is August. The third shock arrives in August 1994, when the Federal Reserve, which has been raising U.S. interest rates since February to control American inflation, raises rates again. Higher U.S. rates make American assets more attractive relative to Mexican assets, pulling capital toward the United States and away from Mexico. The peso is under pressure from 3 directions at once: the Zapatista shock, the Colosio assassination, and rising U.S. rates. The government defends the peg by selling reserves and by issuing more tesobonos to keep investors in Mexican paper. Each new tesobono issue is a promise to repay in dollar terms. Each new issue adds to the pile of dollar-denominated obligations sitting on top of a shrinking dollar reserve base. By September 1994, the internal calculations at the Finance Ministry show that the reserve position is becoming critical. A memo prepared by the ministry's debt management unit, which does not become public until 1998 when it surfaces in a congressional investigation, warns that at current trends, Mexico will face a liquidity crisis in the first quarter of 1995 unless either reserves are rebuilt through new borrowing or the peso band is widened to reduce the intervention cost. The memo recommends action. Salinas, who is in the final months of his presidency and determined to hand a stable economy to his successor Ernesto, chooses to maintain the band and continue defending the peso through the election. Zedillo takes office on December 1, 1994. 14 days later, on December 15, his incoming finance team sits down with ASP's outgoing team for the formal handover briefing. The incoming team sees the reserve figures for the first time. Reserves are down to approximately $12 billion against $29 billion in tesobonos coming due in 1995, most of them within the first 6 months of the year. Zedillo's team has 2 weeks to decide what to do with a situation they did not create and did not know the full dimensions of until it was in their hands. On December 20, 1994, the new government announces a modest widening of the peso's trading band. The band is widened by 15%. The announcement says, in the language of currency management, that the government remains committed to the peso's stability within the new range. Financial markets read it differently. If the government has widened the band by 15% today, they reason it will widen it again tomorrow and then abandon it entirely. Investors begin selling pesos. By December 22, the government abandons the band entirely. The peso is now floating. In a market with almost no dollar reserves to absorb the selling, floating means falling. The peso loses half its value in 2 weeks. This is the top. Nobody knows it yet. Then something happens that the architects of Mexico's reform program have never modeled. The tesobonos trigger a global panic. Here is the mechanism. When the peso devalues, investors who hold tesobonos technically do not lose money in dollar terms because tesobonos are indexed to the dollar, but they can only convert their tesobono proceeds back to dollars by selling pesos at the new weaker exchange rate. And the Mexican government, which has promised to make the tesobono payments in dollars, has almost no dollars, so even though the tesobono is dollar-indexed in name, the practical reality is that the Mexican government cannot pay. It is not a devaluation risk, it is a default risk. The word default moves through the international bond markets within hours of December 22. International investors who hold Mexican government securities begin selling everything Mexico. Mexican stock market, Mexican corporate bonds, Mexican bank debt, all of it. The peso falls further. Mexican interest rates spike to defend the peso and instead accelerate the capital flight because 80% interest rates signal that the government is desperate. By early January 1995, the question is not whether Mexico will default on its tesobonos, but when. And then the contagion moves. Portfolio managers in New York and London who hold Mexico also hold Argentina, and Brazil, and Thailand, and Hungary. The logic is not that Argentina is like Mexico or that Argentina has the same problems as Mexico. The logic is that the manager who is wrong about Mexico might be wrong about all emerging markets, and the safest thing is to reduce exposure to all of them while the picture clarifies. In January 1995, Argentine interest rates spiked by 7 percentage points in 2 weeks. Despite the Argentine economy being in reasonable shape, the Buenos Aires Stock Exchange falls 20%. This is the Tequila effect. a term that economists coin in the weeks after the crisis. A Mexican problem infects countries with no connection to Mexico through the single channel of investor risk aversion applied uniformly across an asset class. Roberto Hernandez had been the general manager of a medium-sized textile manufacturer in Monterrey since 1991. His company had borrowed in dollars during the boom years because dollar interest rates were lower than peso rates, and the peg made the exchange rate risk seem theoretical. When the peso devalues 50%, his dollar debt doubles in peso terms overnight. His revenue is in pesos. His employees are paid in pesos. His domestic customers pay in pesos, but his debt is in dollars. He tries to renegotiate with his bank in January 1995. The bank is itself in crisis and not in a position to offer terms. He reduces his workforce from 340 to 190 by March 1995, shuts 2 of his 3 facilities by June, and files for protection from creditors in August. He loses the company. He does not lose his house. Barely. He starts again in a smaller line of business 5 years later. He tells an interviewer in 1999 that he trusted the government when it said the peso was sound. He says this without bitterness. He says it like a man describing a fact about the weather. Elena Acevedo worked for 15 years at a branch of Banco Surfin in Mexico City, rising to branch manager by 1993, on the strength of performance reviews that consistently praised her client service. In January 1995, the bank's non-performing loan ratio spikes from 9% to over 30%, as borrowers default across the board. Surfing, like most Mexican commercial banks, privatized in the early 1990s and loaded up with consumer and corporate loans during the boom, requires a government bailout that will eventually cost the Mexican government an estimated $65 billion, roughly 15% of GDP. Elena keeps her job through the crisis, but watches the institution she has spent her career in be absorbed, restructured, and eventually sold to Santander of Spain in 2000. The branch she manages for 15 years is closed in the rationalization. Stanley Druckenmiller, the hedge fund manager who works with George Soros, has been positioned short the Mexican peso since mid-1994 after his team runs the same current account and reserve analysis that Dornbusch published. Soros's quantum fund makes an estimated $500 million on its Mexican positions in the December to February window. Druckenmiller says in a 1995 interview that he felt no moral conflict about the trade. He had analyzed the data and acted on what he found. He is not wrong about that. The data were available. Most people did not read it. And still nobody asked the real question. So what does the conventional story say about Mexico's 1994 crisis? It says the Salinas government overspent, kept the peso overvalued for too long, and triggered a loss of confidence when the fiscal and current account reality became too large to ignore. That story is incomplete in a specific way. It treats the crisis as a local Mexican failure when the mechanism that made it a global crisis was a financial instrument specifically designed to attract and retain foreign capital. The Tesabonos story reveals something about how international capital markets generate crises in countries that are trying to do the right thing. Remember Pedro As, who designed the stabilization and believed in the peg. He has given extensive interviews in the years since 1994 in which he argues that the crisis was triggered by political shocks outside his control and that the fundamentals of the reform program were sound. He is not wrong about the shocks. The Zapatista uprising and the Colosio assassination were not outcomes that any financial model predicted, but the mechanism that turned those shocks into a crisis was one his own ministry designed. Tesabonos are issued when foreigners start getting nervous about holding peso-denominated debt, as a way of offering them a hedge against devaluation by denominating the debt in dollar terms. They solve the short-term problem of keeping capital in Mexico, but they create a future obligation to pay in dollars regardless of what happens to the peso, which converts the government's currency risk into a default risk. The hedge that keeps foreigners in today is the bomb that detonates tomorrow. The mechanism runs precisely like this. In normal times, a government with a currency peg funds itself in local currency. When the peg comes under pressure and investors want to exit, the government issues dollar-indexed debt to keep them in. The dollar-indexed debt requires dollar reserves to service. The pressure on the peg drains dollar reserves as the government defends the exchange rate. The declining dollar reserves reduce the government's ability to service the dollar-indexed debt. Investors, seeing the reserves declining, sell the dollar-indexed debt faster because default risk is rising. The selling drains more reserves. the reserves run out. Mexico went through this entire cycle in approximately 8 months, from April to December 1994, while the government published reserve figures on a 3-week lag that prevented anyone outside the Treasury from tracking the dynamics in real time. The new paradigm in 1994 crisis is the Washington Consensus itself, the set of policy prescriptions, fiscal discipline, trade liberalization, privatization, exchange rate stability, capital account opening, that the IMF and World Bank had been prescribing for developing economies since the mid-1980s, and that Mexico had implemented more completely than almost any other country. The belief, widely shared among the economists who designed the programs and the politicians who implemented them, is that following this playbook reduces crisis risk. The Salinas government had followed it. The crisis happened anyway. A 1995 IMF working paper by Timothy Lane and Stephen Phillips examines the Mexican case and concludes that the Washington Consensus policies are necessary but not sufficient conditions for stability, and that rapid capital account opening without adequate supervision of the banking sector creates fragilities that offset the benefits of the other reforms. The paper is published 6 months after the crisis. The prescriptions the IMF gives the next set of reforming countries do not change in time to matter for Thailand in 1997. Easy money is the capital inflow surge of 1990 to 1993, when Mexico receives more foreign portfolio investment per capita than almost any other developing country, attracted by the combination of high interest rates, the stable peso, the NAFTA story, and the general enthusiasm of international investors for emerging markets as a new asset class. Between 1990 and 1993, net capital inflows to Mexico total approximately $91 billion. The inflows finance the current account deficit and keep the peso stable. They also build the exposure that amplifies the exit. When the capital flows reverse, they reverse faster than they arrive because selling is faster than buying and because portfolio managers react to the same news simultaneously. Social proof is the investment grade credit rating that moves, and Standard & Poor's maintain on Mexican government debt through most of 1994. Ratings that signal to international investors that Mexican sovereign risk is comparable to investment grade corporate bonds in developed markets. Both agencies downgrade Mexico to speculative grade in January 1995. A Congressional Budget Office report from 1995 notes that the agencies maintained their ratings based on the public information available to them, which did not include the real-time reserve data that the Finance Ministry held. The ratings are not wrong given what was publicly known. They are wrong given what existed. Complexity is the Tesabono structure itself, a dollar-indexed instrument that pays in local currency but is calculated against the dollar exchange rate is simple enough to explain in a sentence but complex enough in its risk dynamics that most of the investors who held $29 billion worth of them could not have told you accurately what would happen to their position in the event of a simultaneous devaluation and default. When both happen at once, the answer is everything bad. Peak euphoria arrives at the signing of NAFTA in December 1993, when the political achievement and the economic thesis seem to be simultaneously validated. When Time magazine runs a cover story on the Mexican economic miracle and Morgan Stanley issues a research note recommending Mexico as the single best emerging market investment for 1994. The warning that is dismissed is Dornbusch and Werner's Brookings paper, published in February 1994, which ASP's office explicitly rejects in a written response to the journal, arguing that the current account deficit reflects investment inflows rather than excessive consumption, and that the overvaluation calculation uses an inappropriate base period. The trigger is the band widening on December 20, 1994, a 15% adjustment that the incoming Zedeo team intends as a controlled release of pressure and the market reads as the beginning of an uncontrolled exit. And the blame game runs for years. Salinas is blamed for maintaining the peg too long and hiding the reserve data. The outgoing team is blamed for the timing and execution of the handover. The incoming team is blamed for mismanaging the announcement. The IMF is blamed for prescribing capital account opening without adequate banking supervision safeguards. The rating agencies are blamed for maintaining investment-grade ratings on misleading information. Alan Greenspan is blamed for the Fed rate hikes that triggered capital outflows. All of these things contributed. None of them is the whole story. Once you see this pattern, you cannot unsee it. Now look at 2025. Egypt's foreign exchange reserves stood at approximately $27 billion in early 2025, against external debt service obligations of over $40 billion due in the next 12 months. The Egyptian pound lost 50% of its value between 2022 and 2024 in a series of managed devaluations that the government resisted until the IMF made further disbursements conditional on exchange rate flexibility. Egypt has received 3 separate IMF programs since 2016, each one addressing a version of the same structural problem: a current account deficit financed by short-term capital inflows that exit when global risk appetite shifts, a banking system loaded with government debt, and a government that funds itself through instruments designed to attract yield-seeking foreign investors at the cost of concentrating the exchange rate risk on the sovereign balance sheet. Sound familiar? New paradigm. The current version in frontier and emerging market economies is the narrative of IMF-supervised reform, in which a country that is implementing a program approved by the IMF should be considered a safe investment because the program provides a backstop. This narrative is accurate in the sense that IMF programs do reduce default risk relative to no program. It is misleading in the sense that IMF programs reduce but do not eliminate crisis risk, and investors who use IMF program status as a substitute for their own analysis of reserve adequacy and debt maturity structure are repeating the mistake that Mexico's creditors made in 1994. Easy money is the Gulf Cooperation Council bilateral lending to Egypt and several other Middle Eastern and African economies that has been running at elevated levels since 2022, providing balance of payments support that fills reserve gaps without requiring the fiscal adjustment that IMF conditionality demands, creating a situation where multiple sources of financing with different conditionality requirements are operating simultaneously in the same economy, making the total debt picture more complex and the risk dynamics harder to model than any single lender can see. Social proof is the Eurobond market's willingness to lend to Egypt at spreads that have narrowed significantly from their 2023 peaks, with international investors returning to Egyptian sovereign paper in late 2024 based on the stabilization of the pound and the IMF program, in a dynamic that resembles the 1992 to 1993 return of capital to Mexico after the initial stabilization. Success. Complexity is the carry trade structure, through which international investors borrow in dollars at low rates, convert to local currency in Egypt or Turkey or South Africa, invest in high-yielding local currency government bonds, and hedge the exchange rate risk through currency forwards. This structure generates returns when local currencies are stable and rates are high. It generates simultaneous large-scale currency selling when the carry trade unwinds, because all the participants are hedging in the same direction and all the hedges expire at similar maturities. What is genuinely different now? The IMF's flexible credit line and precautionary and liquidity line instruments, established after the 2008 crisis and expanded since, allow countries that meet pre-qualification criteria to access large volumes of IMF financing quickly without the stigma and conditionality delay of a traditional program. Mexico itself has held a flexible credit line since 2009, and the existence of that line almost certainly reduces the probability that Mexico will face a 1994-style liquidity crisis, because the line provides a credible backstop that slows the exit dynamic. Countries without precautionary arrangements, which is most of the frontier markets currently running large current account deficits funded by short-term capital inflow, have no equivalent backstop and remain vulnerable to the same exit dynamic that hit Mexico in 72 hours. Watch for any emerging market where the ratio of short-term external debt to foreign exchange reserves exceeds 100%. That ratio, published quarterly by the World Bank and the BIS, is the closest thing available to an early warning indicator for the specific crisis type Mexico experienced in 1994. Watch for the spread between local currency government bond yields and U.S. Treasury yields in countries running current account deficits above 4% of GDP, because the spread measures how much yield is needed to keep foreign investors in local paper, and the spread that is widening while reserves are declining is the reserve depletion dynamic running in slow motion. And watch for any government that increases its issuance of dollar-indexed or foreign currency-denominated domestic debt in response to investor demand for hedging, because that instrument is the Tessa Bono in different clothing and it concentrates the same risk, not predictions, a pattern. The pattern is there. The question is whether you will recognize it in time. So why do we keep building this trap? Governments facing capital flight do not choose the Tessobono out of ignorance. They choose it because the alternative is immediate pain, and the Tessobono provides immediate relief. A government that widens its currency band or raises interest rates sharply to defend the peg faces a recession, unemployment, and a political crisis. A government that issues dollar-indexed debt to keep foreign investors in the game buys time. The time might be enough to resolve the underlying imbalance, or the underlying imbalance might persist, and the time bomb of dollar-indexed obligations might grow larger during the delay. Mexico's government chose the delay. The 1994 political calendar, a presidential election in August, made the delay irresistible. The structural logic of electoral incentives made it almost inevitable that the adjustment would be delayed past the election, and that the new government would inherit a situation that had been made materially worse by the delay. This is the human element that purely technical analyses of currency crises miss. Roberto Hernandez, who lost his textile company, and Elena Sucedo, who watched her bank be dismantled, made reasonable decisions based on the information their government gave them. The peso was stable. The reform was working. NAFTA had passed. The president said everything was fine. Everything was not fine, and the people who knew it was not fine. The finance ministry officials watching the reserve data, the IMF staff who received the quarterly reports, the hedge fund analysts who had run the Dornbusch calculation, had information that the Robertos and Elenas of Mexico were not given in time to change their decisions. The gap between what the government knew and what the public was told, the 3-week lag on reserve data, the December 20th announcement that framed a necessary devaluation as a modest adjustment, is not a detail. It is the mechanism by which ordinary people absorb the cost of a crisis that sophisticated actors had time to exit. The $50 billion rescue package that the United States and the IMF assembled in February 1995, channeled through the U.S. Exchange Stabilization Fund in a decision made by the Clinton Treasury under Robert Rubin and Lawrence Summers without congressional approval, stops the bleeding. Mexico repays the full $20 billion U.S. contribution by January 1997, ahead of schedule, with interest. The recovery is faster than anyone predicted. GDP growth returns in 1996. By 1998, Mexico's reserves are rebuilt and the crisis is a memory rather than a continuing reality. The speed of recovery is used by the IMF and the U.S. Treasury as evidence that the rescue package worked. It did work. The question that does not get asked is what would have happened to the countries that do not get a $50 billion rescue package. The question that Russia answers in 1998 and Argentina answers in 2001 when they run through the same dynamic without the same backstop. Cannot personally model Mexico's reserve dynamics or forecast an Egyptian devaluation. What you can control is your own exposure to assets whose return depends on a currency peg holding. When a high-yielding emerging market bond fund is described as safe because it hedges currency risk, the hedging instrument is a contract that works under normal conditions and fails under the exact conditions when you most need it to work, which are the conditions when everyone is trying to unwind the same hedge simultaneously. The hedge is not a hedge against crisis. It is a hedge against volatility. Crisis and volatility are different things, and Mexico in 1994 is the case study that proves it. History records the Tequila crisis as a Mexican story. The contagion to Argentina, Brazil, and Thailand in the first weeks of 1995 makes it an international story. And the structural mechanism. A government issuing dollar-indexed debt to keep foreign investors in a currency it cannot ultimately defend makes it a recurring story. The names change. The currency changes. The Tessobono becomes the GKO in Russia, becomes the Argentine provincial bonds, becomes the Turkish lira-denominated foreign-held securities. The mechanism runs the same. The exit happens at the same speed, and the ordinary people who trusted their government's signals about stability absorb the same cost. Now I want to hear from you. Which current emerging market do you think is running the Tessobono dynamic right now? Accumulating short-term dollar obligations against a reserve base that cannot cover them if the capital exits. And what reform to the international financial system, if you could implement it today, would most reduce the lag between when a government knows its reserve position is critical and when the public can act on that information? Those are not abstract questions. The IMF data transparency standards that were tightened after 1994 are the answer to the second question. And they are still incomplete. Drop the specifics in the comments. If this changed how you read the next story about an emerging market currency crisis, hit the like button and subscribe. Next time, we are going inside the story of how a single Dutch trading company became the first corporation in history to sell shares to the public, built a private army larger than most national militaries, and then collapsed in a scandal that took the Dutch government with it. History does not repeat, but it rhymes. And right now, it is rhyming loud. See you in the next one.